At Monash Investors, we have a strong selling discipline. The first trigger is the price that we assess the stock should trade at. Once it's gotten to that price, there's no point hanging around, we sell out. And along the way, we trim the weight of the stock as we get to it. The next trigger, of course, is if it violates the reason that we're there. We have an investment thesis for every stock. And if we're wrong and we realise it, we'll sell out completely. However, that's often a late trigger, and so we've developed 3 early warning triggers. The first one of these is if there's a spike in short interest. Obviously, if somebody else is shorting the stock, they don't think it's compelling, quite the opposite. The second is an unexpected downward earnings revision. We weren't expecting it to happen, things aren't going as well as we'd like, that's another early warning trigger. And finally, we've developed signposts for each of our stocks, things that we expect to happen in the near term. And as long as those things are happening, we're on track. If not, that's an early warning trigger. Now, for each one of these, we'll cut the portfolio weight of the stock by 1/3. If we get 2 in a row, we're completely out of the stock. In this way, we stop ourselves falling in love with a company when things aren't going right, and we don't suffer a death of 1,000 cuts on a stock. Selling discipline is even more important than knowing when to buy the stock.